what does Kohn's departure mean for the bond market, which watches, of course, as you know, every move that the Fed makes? Joining us right now is Jim Caron. He's the global head of interest rate strategy at Morgan Stanley. And Jim, great to have you here on Street Smart. Lots to talk about. Got to ask you about this news, though, about Kohn's departure. How significant is it in your world?
Well, I mean, clearly it's very significant. I don't know that it necessarily had a very big market moving impact today, so I'd probably judge it based on that. Certainly, the Fed's communication of monetary policy, which needs to be very, very clear, and they get points for being very, very clear in the market. You know, Kohn was definitely a mastermind of communicating monetary policy. He was a big part of that team. But, you know, Bernanke's been pretty steady as well. So, you know, we're going to really follow the stewardship of Bernanke and, you know, the overall, you know, members of the Fed. So, you know, I think the market's taking this in stride. It is a big loss for the Fed. As you mentioned, he is an icon at the institution. But I think that we're going to get through this, and, you know, the markets are handling it so far very well.
And also, I would assume it's not wholly unexpected that after a guy's been somewhere for 40 years and is 67 years old that he decides he may retire. Can you imagine who would be a good fit to replace John Kohn, or who any of the fill-ins here that the president could appoint in his tenure could be?
Well, I'd hate to speculate on that. You know, certainly I can tell you what the criteria would need to be. The criteria would have to be a very, you know, clear communicator of policy, you know, somebody that can bring the gravitas to, you know, to the Fed and to help Bernanke do what is a very, very tough job ahead of him right now. But to name the specific person, I think he has a rich field of candidates to choose from.
Jim, let's also talk about what's going on in the two-year Treasury trade. We've got a story on the system, on the Bloomberg, about Bernanke making a two-year Treasury note sweetest spot. Talk to me a little bit about what we're seeing in that two-year note.
Yeah, absolutely. I mean, look, if you pull up a chart of the two-year yield and you go back over the last year, what you're going to find is that the two-year yield has been in a very, very steady, very steady range. So what Bernanke's been communicating to the market is that he's going to keep front-end yields lower for an extended period of time. Now, that's very, very good news for the front end in the sense that, you know, any investor of the two-year note, even though the coupon on that bond is relatively low, is roughly making about a 1% return on this asset. Now, when you compare that to T-bills, you know, over the next year, when you compare that to a one-year T-bill at 30, you know, at 0.3%, you know, that return on the two-year note is pretty good. Now, on top of that, it's also been a very, very stable sideways pattern in that yield, meaning that the return per unit of risk is also pretty high. So on a Sharpe ratio basis, for example, you're getting about a 5-to-1 Sharpe ratio, which is pretty strong. So you're getting a lot of return, you're getting and you're taking very, very little risk. So for anybody who's looking to, you know, hide their money out and invest in something during these times of uncertainty, I think that the front end becomes a very attractive place to do that.
I wonder what you think about the 10-year. I mean, people have been forecasting higher rates this year. Obviously, it's only the first day of March here. But some, Morgan Stanley looking at 5.5%. Do we get there? Do you think we get that high?
Yeah, you know, we do think that the risks are pointing that way. And what's good news for the front end isn't necessarily good news for the back end. So just because the Fed is keeping front end rates low, which may be good news for the two-year note, what's also happening right now is that we're allowing, at this point in the economic recovery cycle, we're allowing some inflation pressures to start to build. So if the Fed is going to keep front end rates low, then that means the only point of vulnerability on the curve for yields to actually rise is the back end. And that's one of the reasons why we think that the back end rate move higher could be exacerbated. So in other words, what we start to do is build inflation and inflation expectations where the back end yields need to rise to offset those risks, and that's one of the reasons why we think that the curve continues to steepen and that you may get yields north of 5% towards the end of the year.
All right, good to know. Hey, Jim, we got to leave it on that note. Jim Caron of Morgan Stanley.